Hey, what's going on, Orlando? This is Ty Fan here over at Keller Williams at the Parks. I am a realtor here in the Orlando, Florida market, and right here next to me is Mr. Rhett Delaney from Move It Mortgage. And we thought we would just have a simple conversation between Rhett and myself and really ask a lot of popular questions and answer these questions that we're having in this current market right now. And first off, Rhett, I'll put you in the hot seat real quick. And a lot of my clients are asking a lot of great lender questions that I can answer, but I think it'll be better if you answer it and you can provide more details.
Sounds good. Well, thank you for having me, Ty. So when it comes to getting approved for a mortgage, the first step really is just to get the application started. When we do an application, we look at three main factors: your credit score, your income, and your ability for down payment. Now, there are a lot of different programs out there. There's conventional, which is your standard loan. There's FHA for folks who, whose credit is might need a little work but still qualified. Mm-hmm. We have our VA loans, which are for our veterans. Thank you for your service, of course.
Absolutely.
There's USDA loans for rural development, and then of course there's a lot of different other loans such as jumbos and non-QM. But at the end of the day, the first step is to get the application started, so then we can figure out what program is best for you.
Okay, so get the application started, and let's say that a buyer goes in and gets the application started and they come back with these different loans. So let's segment that real quick. Can you tell me about what a conventional loan is? What does that mean?
Yeah, so conventional loans, your standard Fannie Mae, Freddie Mac loan, which is the main investor for the majority of loans here that we do. So with the conventional loan, you can put down as little as 3% as a first-time buyer. There's a big misconception that conventional loan requires a 20% down payment, but you can do as little as 3%. The difference is when you put down less than 20%, you are subject to what's called PMI, which is private mortgage insurance, which the benefit on a conventional loan is that it's not for the life of the loan.
Gotcha.
But it is based on your down payment and credit score. So the rate on your PMI can vary a bit, but just like your main interest rate, it's going to be based on your credit score and your down payment.
So Rhett, you actually mentioned PMI, private mortgage insurance. Can you explain to me what private mortgage insurance is and why that is set in place?
Absolutely. So with PMI, or private mortgage insurance, it's basically a policy that's imposed on your mortgage when you put down less than 20%. That policy, what it covers is a safety net for the investor for doing your loan against you defaulting on your mortgage. So unfortunately, it doesn't truly benefit you, but it's there to allow you to put down less than 20%, and it mitigates any risk for the lender when you're putting less than that 20% down. But the good thing is, on conventional financing, the PMI does go away. Goes away at 20%. So once you have 80% loan to value of your original appraisal, the PMI will go away. But in this market, what we've seen happening with the rapid appreciation and home values going up, that people have been able to call their servicers, request a new appraisal, even if they've only had the home for 18 months or 2 years or so, and get a new appraisal and then get the PMI removed without having to do a whole refinance. So that's one of the great benefits of a conventional loan. FHA mortgages do have what they call it, instead of PMI, they call it mortgage insurance premium, so MIP. Why there's a difference, I don't know. But anyway, FHA has two versions of the mortgage insurance. One, there's a monthly premium, which is static at 0.8%. So that's one of the benefits of an FHA loan. If your credit might need a little improvement, whether you have a 620 score or a 680 score, the rate for the mortgage insurance will be the same. But they also do charge you a 1.75% funding fee, basically upfront mortgage insurance premium, they call it, that gets financed into your loan. So
it is financed into the loan itself, so that's not an upfront cost that they have to pay in whole.
Correct. It's basically an upfront premium, just because the FHA loans are considered a little bit more risky, so there's an additional premium that is charged in there. Now, it's a great loan because it opens up more options for more buyers, but conventional is what we try to do first. If we can't do conventional, then we'll go FHA. The difference on the FHA is that the mortgage insurance, unfortunately, is for the life of the loan. So the mortgage insurance will not go away no matter how much you pay down. So eventually, if you're going to plan on keeping the home, we'll look at refinancing down the road.
So if you want, if you have an FHA and you're paying PMI, the only way to remove the PMI is to refinance it in hopes that you get approved for a conventional loan.
Correct.
Okay, perfect. Now, so you covered conventional and you covered FHA. Now let's talk about our amazing veterans out there. There's a lot of people out there who are giving their life and their service to us. What type of loans do we have for those amazing veterans out there?
Yeah, so we have our VA loan, which Veteran Affairs loan. The VA loan has a great benefit of having the option for a 0% down. So whether you want to do a $300,000 loan or up to, you can go as high as a 1.2. It actually, there's no limit on VA loans as long as the borrower is well qualified. So
there's a lot of veterans out there who are very excited, like really 1.2? Oh man, I'm excited.
certainly. But at the end of the day, we want to, of course, put people in the right payment. But
right.
The great thing about VA loans is that there is no limit on the loan. So it just opens up so many options. The only thing that the buyer has to cover on the VA loan are the closing costs, which run about 2% or so on a VA loan, because we as the lender on a VA loan do not charge our normal application fees. We actually waive those fees for our veteran just as an added benefit.
So what about, did you talk about down payments? About our VA loans for down payments?
The zero down.
Oh, that's right. That's exciting. I mean, that's and well deserved, right? For our
Absolutely.
VAs out there, you guys shouldn't have to pay down because you're giving our lives to our country. So, okay, so great. Another question that we get all the time, especially I do, is, they're like, Ty, listen, I'm scared that I might not get approved for a loan, just because I don't have perfect credit, I have debt. Do you have to have perfect credit and be debt-free to get approved for a loan?
No, absolutely not. That's why there's so many different programs to try to give opportunity to all buyers out there. Now, we can't say we can approve everybody, but we do everything possible to get folks approved. And even if we can't get you approved right now, we're going to get you on a game plan to help maybe build your credit, establish a down payment, to really work on getting you the ability to be approved down the road. Because at the end of the day, credit is a fluid, judging system.
Yeah.
Just because someone has bad credit right now, it does not mean they can never get it fixed. There's always a way to fix credit.
Right.
Might take some work, might take a little sacrifice, but credit can always be improved. It just might take a little time.
Yeah, if you want it, you put the work for it, right?
Yep.
All right, so thank you for that. Okay, so you did talk about, I do get questions I'll ask all the time, and you kind of mentioned it earlier when going through conventional, FHA, and VA, but they asked me, Ty, I don't have 20% to put down, I don't have 10% to put down. Do I have to put that amount down to get approved for a loan?
Yeah, like I said, as a first-time buyer, conventional, you can put down as little as 3%. FHA is 3.5%. VA is 0%. If you have bought a home in the past and you're looking to buy another home, conventional loans would be a minimal of 5% down.
Love it. Okay. So a person that is very credit conscientious, they want to make sure that the credit is good always. Obviously, when they apply for a pre-approved loan, they always ask me, okay, well, Ty, you always recommend to shop around for lenders and things like that, but that requires me to run my credit every single time. Does running my credit with different lenders impact my credit, hurt my credit score?
So when you're shopping for a mortgage, just like you're shopping for a car, you're probably going to pull your credit at multiple financial institutions. When you're doing it for the same business purpose, it all is treated as basically the one pull, as long as it's within a reasonable amount of time. Usually within a 30-day period. Gotcha. If you pull credit for a car this month and then you pull credit for a house next month, or a credit card or anything like that, then you might start seeing some fluctuations in your score. 5, 10, 15 points or so. But if you got a game plan, you're going to shop all for your lender right now, do it all at once, so it's all treated as one, so you won't see any big fluctuations in your score. And then furthermore, when we pull your credit, it is good for 120 days. So if as long as we close on a house within that 120-day period, we don't have to check credit again.
So just to recap, so essentially, if you are thinking about buying a home and you run credit with different lenders like Moving Mortgage or Bank of America or things like that, whatever the case may be, as long as within a certain time frame, they're going to be like, oh, John Doe is probably applying for a house right now. We'll probably just ding his credit just once.
Right.
So essentially what that is, what you're trying to say.
Mm-hmm.
Okay,
Correct.
Gotcha. Perfect. That's a great way to sum that up. average times for a loan process right now in this market?
Yeah. So the average loan contract right now is 30 days. That's kind of the standard from contract to close. Our goal is to have you fully underwritten within 24 hours and the loan processed within 7 business days. The only thing that seems to be causing a few delays out there in the market are appraisals. There are just not that many appraisers out there, and there's a lot of homes being sold. Now, granted, now that the refinance market is toning down a little bit, I think it's going to free up those appraisers. We'll see some better turn times. But our goal is to get you underwritten within 24 hours, fully approved with a conditional approval within 7 business days, and have you clear to close before your closing date. We don't want you to be stressed before your closing date.
Perfect. Great. My last question, and then it'll be your turn to have the power here before asking me questions here.
Certainly.
But I guess this is actually a really important question. I think probably the most important question out of all the questions I've asked you so far is obviously, why would a buyer go with a actual mortgage lender versus like a traditional bank, like a Bank of America or Wells Fargo or SunTrust, things like that?
Certainly. So when we look at, what's the pros and cons of using a direct lender, which is what I do, the company I work for, we solely do mortgages. That's all we do, day in, day out. That's our, that's our mission. Whereas a bank, more of a jack of all trades, not saying that they can't process your loan or can't close your loan, but from the feedback that I get from my realtor partners, it just always seems like the banks are taking longer to process a loan, or they're having more issues with underwriting, and there's more red tape. Whereas, we're experts at our one trade, and they're kind of a jack of all trades. Furthermore, when it comes to the way we process our loans and the way we communicate, I work with my team, with my realtor partners as basically a team. We want to make sure that at the end of the day, if a home comes up and you have the opportunity to make an offer on it, that you do not miss out on that house. Right. Whether that's on a Friday night or a Saturday or Sunday, we are available to take those calls, make sure you get an updated pre-approval letter, or if you haven't been approved, we can get you pretty much pre-approved within about 30 minutes. And so you're eligible to make an offer on that house that just came on the market that probably won't be there by Monday. Whereas the banks, a lot of them are closed, a lot of them don't take calls on the weekends. We just want to make sure that we provide the best service and the best communication to ensure that your offers look the strongest.
Yeah, and I'll actually contest to that too, because give you a positive testament. I actually had a client, you might actually remember her. She's a doctor and perfect credit, great income, obviously, as you imagine, becoming her profession. Her situation was a little bit different because she had, standard W-2s, things like that, and then she merged into her LLC, and didn't have her LLC more than, I think it was like 1 year. And to make a long story short, she had applied for a mortgage loan with 6 other different lenders, and they all denied her. But fortunately, Mr. Rhett Delaney here with Movement Mortgage was able to approve her for her house. Out of 7 total lenders, Movement Mortgage was the only one that able to get to approve her, and she is ecstatic and loves her house. Yeah.
And it's not because we did anything that the other lenders couldn't do. We just, we are experts at our trade, and I've been in the mortgage business almost 10 years now, and closed a lot of loans and seen a lot of scenarios, and we interpreted the guidelines as such and realized that there was an opportunity to help her get into this home, and at the end of the day, got it closed.
It worked out, and she's happy. So the moral of that story is, if you're going to shop around, at least one of those lenders need to be Moving Mortgage for sure.
Absolutely.
All right, man. I'm ready for you. What you got?
So, right now, obviously, it's a crazy market out there. It's a seller's market. That's what everyone keeps saying. What do you do to try to make your buyers' offers stand out, to make them the most appealing in a multiple offer situation?
Yeah, so like Rhett said, we are definitely in a seller's market right now. I think homes are going out or being off the market within 48 to 24 hours, sometimes within 24 hours. It's just crazy. It's just how it is right now. If you really want to make your offer stand out, rule number 1 is to get a pre-approved letter. And I say that for 2 reasons. The first main reason is that by getting a pre-approved letter, talking to a lender like Moving Mortgage and Mr. Rhett Delaney here, it gives you a better picture of what type of house you can get, right? It keeps in perspective, so that way you're not falling in love with the house and all of a sudden you're like, oh, I can't get that house.
Right.
And it hurts. It hurts me as well. as a home buyer myself. But the second reason is that sellers will not take your offer seriously if you do not have a pre-approved letter. A pre-approved letter shows the seller that you mean business, that you've ran your credit, that you're pre-approved, and that you're good to go. The problem we're seeing right now is, and I'm actually personally experienced this with one of my clients, is that they say, "Oh, I'm just going to look at homes right now, and then if I like it, I'll apply for the pre-approved letter, and then I'll put in an offer." But like we said, houses are coming off the market within 24 hours. So if you're absolutely in love with this house I just showed you, and then you apply for a pre-approved letter, well, guess what? It's already off the market.
Yeah, no, you can't put the cart ahead of the horse.
Yeah, absolutely not. Absolutely not. So pre-approved letter, rule number one.
Yeah. And we work as a team, and when any of those offers are going out, so to try to make your offer stand out even more. Anytime you make an offer, I'm reaching out to the listing agent as well to talk about you and talk you up as a buyer, saying how well qualified you are. But we've already validated all your credit, your income, your assets, and that if we get the privilege of being accepted as the buyer for that home, that we guarantee we're going to close this loan for you.
Absolutely. Mm-hmm.
And now, with also, being a seller's market, for anyone who thinks that they, maybe wait for the market to cool down, what are your thoughts on that? What do you think is going to happen in the next 12 months?
Yeah, listen, I get it. Like I said, we are in a seller's market. Sellers are definitely getting top value for their homes. Let's just be completely honest. That's what it is. But what you have to keep in mind as well is that even though prices of our homes are up, so is rent. Mm-hmm. We actually pulled the latest numbers, and on national average, it was 19% up from last year. And we're just talking about a one-bedroom apartment. They're showing about $1,600 for a one-bedroom at the national average. And that's a scary thing. So if you're doing the smart thing and you are saying, you know what, I want to buy a home, I want to set money aside every month so I can put it down towards a down payment on the home. Well, if you're renting right now and you are thinking of holding off until the market cools, if it cools, right? Well, because of the rise of rent, now the money that you're putting away towards savings, you're taking a portion of that back to cover the cost of rising rent. Mm-hmm. So my rule of thumb is to, if you are serious about purchasing a home, one, reach out to a lender and see what you can get approved for, and make action. Because even though you may probably paying top dollar for your house, this still is an investment that you're getting back. If you're renting, that money just goes away. Mm-hmm. You have to think about $1,600 for a one-bedroom apartment, times that by 12. That's the money you're not getting back. You're not reinvesting into yourself. However, if you have a mortgage and you're paying these mortgage payments, it's kind of like what Brett would like to say, like kind of like a 401k. You're putting that money back into yourself.
Yep, absolutely. Home values year over year have been on fire, 15 to 18% year over year, depending on your neighborhood. Mm-hmm. Is that sustainable? Probably not, but more realistically, home values will continue to go up 8 to 10%. Yeah. So, think of it, like Ty said, as almost like a 401k, where every month you're going to put a little bit into it. It's going to appreciate in value a little bit. There might be some market fluctuations, but at the end of the day, historically speaking, values will always continue to rise. So it's, when you cash it out, even if you broke even, that's still better off than paying someone else's mortgage at $1,800 to $2,000 a month for rent for money you're not going to see.
Exactly. Perfectly.
Yeah. And then, people, want to understand the, how you as their buyer's agent, how you represent them, and how also does the buyer pay you at the end of the day, or how do you get compensated for your hard work?
Yeah, that's a misconception that people think that buyers actually have to pay the buyer's agent the commission. And actually, the commission dollars comes out from the seller, right? The seller splits the cost with the seller agent because we are assisting the seller agent in the sale of their home. So it's kind of a partnership. So therefore, the actual seller pays the commission for the seller agent and as well as the buyer agent. So you don't pay anything.
Gotcha. And with the lack of inventory right now, which right now the inventory here in Central Florida is there's only enough inventory if, say, a house did not get listed today or for the foreseeable future, no listings came on the market, there's only enough inventory to satisfy the demand for about a month.
That's crazy.
Which is insane.
That's crazy.
So basically saying there's just not enough houses. There's way more buyers than houses out there.
Right.
So what a lot of people have been looking at, they're starting to look at new construction, which might take 9 to 12 months depending on the builder. But a lot of times they think that they just show up at the builder and start picking out stuff, and that's how it's done.
Yeah.
What would you say to that? Because I think you should always have someone in your corner to advise you as you go through any purchase process. How would you help them out?
Yeah, I get that question all the time. Why do I need a realtor if I can go to a new build and they have a representative? And I'm going to answer this in two pieces. And the first one, I want everyone to calm down and be like, no, I knew I don't have to get a realtor, so let me just set that straight right now. Do you need a realtor to buy a new build? And the answer is no, you don't have to have a realtor to do a new build. But the second part of that question is, should you get a realtor to do a new build? And that question is absolutely 100% yes. And the reason why is because, as Rhett said, building a home takes about an average of 9 up to almost a year, depending on the size of your home. And that is, you want a realtor that is experienced in that realm and understands the processes that goes on to building a new home, the phases that goes into buying a new home, from breaking ground to the initial overall frame structure to the overall design meetings to official post-inspection for final close. An experienced realtor is going to understand what to look out for in the best interest for you. Now, Rhett, I get this question asked all the time as well is, well, if I don't get a realtor for my new build, then I might be able to negotiate additional money off because now they're not paying the realtor the commission. And that's actually a misconception as well, because on the back end, the builder actually sets aside a set fund to pay the realtor. If a buyer is not represented, it doesn't go towards a credit towards the buyer. That's just an added bonus for the actual builder.
Right.
So whether you go with a realtor or not, you're not going to have that commission dollar to negotiate the price of your home. So why not bring on a realtor that's looking at the best interest for you, for your family, and your investment, and make sure that your dream home, is actually being built the way that it should be. Absolutely.
It's always best to have someone in your corner that you trust to make sure that everything looks right. Same for when you're financing a new construction. A lot of times the builders that are associated with the construction company are one and the same. They're the same company, so hence they have their best interests at heart, not yours sometimes. Now, there are some good deals out there, not saying that there aren't, but it's always good to at least get a second opinion from an outside lender to make sure that what they're giving you is a good deal, that they're not overcharging you on the rate to quote unquote give you a credit to go towards your closing costs. And then one thing that we can do that the builders can't do, we can do extended rate locks. We can lock your loan up to a year and basically mitigate the risk of rates going up over the next 12 months, which everyone's forecasting that rates could hit 5% by the end of the year, where we can lock you in for a small fee and lock you in at 4 1/8, 4 1/4 right now, and save you thousands and thousands of dollars against the potential of those higher interest rates.
Right.
And even if rates are the same by this time next year, that's okay, because we offer a float down option as well, so that you're going to get the best rate possible at the time of your closing, or you've basically bought an insurance policy to cover any increases in interest rates. So it's one of the added benefits of working with an outside lender, because I've never seen a builder lender be able to do that.
Yeah, that's a really good point. Absolutely. Great point. Mm-hmm.
So a lot of information we've gone over today.
So one thing that I will always ask my clients is that, when they're buying a home, there are important questions they have to ask themselves, right? Because this is a huge investment. This is not just like buying, a $50,000 car or anything like that. You're buying a $100,000 plus and hundreds of thousands of dollars. So you definitely need to ask important questions to yourself. And I always quiz my clients and says, okay, I ask them 3 questions. First off, is this house beautiful on the outside? Yes, right? Second question, is the house beautiful on the inside? Yes. But the third question I ask them, and this is probably the most important question, is this house functional? And what I mean by that is this house functional for the next 3, the next 5, next 10 years. So if you're, let's say, giving you a brief scenario, you're a newly couple that currently live in an apartment and you want to take advantage of putting investment into yourself and buying a new home, well, what does that look like? Are you planning to have kids? Are you planning to, or if you already have a home right now and you have kids and you're expanding your family, does that mean now you need a bigger house with a split floor plan? The most important thing is to think 3 to 5, 10 years ahead of time, because that's the most important thing that you have to consider.
Certainly. I mean, even when it comes to the financing side, on average, people stay in a home about 4 to 7 years. So when it comes to what rate we choose, people ask, can I buy down the rate? Can I pay points, which is a percentage of your loan amount, to buy a particular rate? I want to get the lowest rate possible. How much is it going to cost me? Well, there's always a break-even point of benefit for buying down the rate. If you're going to be in the house for 3 to 5 years, buying points probably won't make a whole lot of sense, because you're not going to be there long enough to recoup the benefit of the upfront cost. And then there's also, okay, if you're going to be in the house for 15 years, what's the time value of money with inflation? Is it better to, keep that $2,000 or so in your pocket to buy something or improve something to the house, or is it better to get the rate down? In most cases, we usually don't buy down rates unless we need to do it to help qualify, to get the debt ratios in line. But like I said, it's always an option, but it always comes down to just making sure we're asking the right questions to meet your financial goals.
All right. Well, listen, we covered a lot of questions and addressed a lot of those questions. And first off, before we close this out, Rhett, thank you so much.
Thank you for having me.
He is a wise man. So if you're thinking about looking for a lender out there, definitely shop around, but make sure Move It Mortgage from Mr. Rhett Delaney here is a part of your option. If you found this video very helpful and you want to see more videos like this, please make sure that you follow my Instagram page and also write a comment of things that you like that really stood out to you. Share this video. I'll actually put Mr. Rhett Delaney's contact information. It should be somewhere around here or maybe up here, depending on where I decide to put the contact information. But Rhett, thanks again. And Orlando, we'll see you next time. Thanks again.
Thank you.